If you are looking at the stock market to determine the health of the economy, you are looking in the wrong place, let me tell you. I'm going to show you where you've got to look. So many pieces of information have come out here, and that is going to be very helpful to you to be able to determine what's actually happening. And so in here today, we're going to look at several different sources. We'll piece that all together, and we're going to make sense of it. Okay, so you'll make better decisions as a result of this. Are you ready? Stay with me. Let's go. First things first, you have the economists that cannot get on the same page. All right, I'm going to show you a couple examples. First thing, the incoming data might even be bullish enough to assume a recession isn't imminent. Quote, this is Goldman Sachs, consumption is 70% of the economy, so you would generally expect these things to be fairly closely related, GDP, as in the economy, growth versus consumer spending growth. And so suggesting that you would have unspectacular growth, but it's still growth nonetheless. Connected in with this, the US is going through a rolling recession, and that's slashed the risk of a hard landing for the economy, according to Bank of America. Now, we're going to see this over and over and over again. The professionals, the experts, they can't make up their mind. They're never on the same page, and they are always willing to make some predictions, but we find that those predictions generally don't come true. What do we know for sure? Well, there are some things fundamentally that are taking place that are part of what we would call a recession. People are spending more money today, but in many cases, it's simply because of inflation. Everything costs more, but guess what? Due to shrinkflation, you're getting less. We experience shrinkflation in products as well as services. And that's going on. We shouldn't be ignoring that. We shouldn't be putting our heads in the sand. We shouldn't look at a stock chart to be able to determine what's going on. That's not accurate. Let me show you some stuff here. Student loan bills will cut $100 billion from consumer spending. The resumption of monthly payments in October increases the probability of U.S. recession as borrowers cut back on their spending, according to Oxford Economics. Depends on who you're going to trust for your information, right? You're going to say, well, what's Bank of America saying? What's this company saying? But isn't it more important to look at something where they can't get around that? They have to pay their student loans. So if they're paying their student loans, they don't have money to spend elsewhere. They're not going to go out to the restaurants as much. They're not going to go to the movie theater as much, and so on. And these student loans are just dragging on. I talk to people all the time that have been paying their student loans for years and years and years after finishing. And that tells you that they cannot take that money. They can't invest it. They can't take that money. They can't put it somewhere else. If they have a student loan, they likely aren't doing what they could be doing in the economy. And this is all being done at a time in which the debt is so extreme already. What's going to happen to that? We have a big concern hanging overhead. American Express kept its annual profit forecast unchanged despite record spending on its credit cards by consumers in the second quarter. But, of course, that's still disappointed in the investors. Never enough. You see this right here. Even though resilient spending on travel and entertainment encouraged company executives to remain optimistic in the second half of the year, the forecast pointed to a potential slowdown. So all they're saying here for American Express, who is considered to be more of the luxury side, that they may be experiencing a slowdown, but at the same time, they're spending more than ever on their credit cards. I've seen balances being carried more and longer than before. So we do have an issue here, and this is something that you've got to pay attention to. There was somebody in the mentorship class that we just had this past weekend that was talking about Bank of America closing down their bank portion, not the credit card portion, the bank portion inside of Mexico. And that tells you something. Something's going on. The whole bank crisis, the financial crisis part 2, is rearing its ugly head, not just in the United States, but other places in the world. So keep an eye on that. Okay, touching on something else here. U.S. corporate debt defaults in 2023 surpassed last year's total. Now, this is where we start to get serious. Because if companies are defaulting, you know there's a big problem. Defaulting, that means they can't pay their bills. Just like you got somebody going, down the road, you might know they haven't paid their bills. The repo man comes to take their stuff. No different than this circumstance for corporations. The total amount of corporate debt defaults in the U.S. have already exceeded the amount in 2022. Experts have been warning that a wave of defaults to hit the economy for some time due to higher borrowing costs. Of course, you could see it all over the place. There's more data, but of course, the point is you increase interest rates, you create a problem. I talked about that years and years and years ago, and the only challenge I ever received on that was, well, they're not going to increase interest rates. They know it's going to break something. Well, they did, and here we are. The U.S. banking crisis paid off for Washington lobbyists. Of course, these guys making money left, right, and center. They work in the industry. They go out of the industry. They come into the government. They come out of the government. It's a revolving door, and they are profiting big time. So you want to know who stands to gain from all of these crises? Lobbyists, certainly, and the big corporations in general. Whether that's in big pharma, could be agriculture, could be financial. It's all over the place. What about this? You could see these two companies, these two financial companies, same scenario. They have slashed their growth forecasts. You can see that all over the place. There's many, many financial companies, in fact, but suggesting that increasing interest rates creates a problem. They refer to this particular thing, the NII, and all they're saying here is that the amount of money that they have to give, I'll explain this quickly, the amount of money. So if you're a depositor, you're putting your money in the bank, they're giving you basically nothing for your savings account. Why wouldn't I take my money out, put it in a money market fund, or put it in I bonds, put it in treasuries? Why wouldn't I do that when I can get 5% or potentially more? Well, the bank then has to say, all right, we got to get them some interest. How are we going to do that? We've got to take some extra risk. We've got to have something that brings us money so that we can then, give these depositors what they want. They want more interest, so we don't lose their money, lose our assets. And then you have fractional reserve banking, which means just a little bit of money lost is going to be devastating to them. So that's what we have. That's the circumstance we're in right now. So you can take it for what you want to, but I think this is a big concern. All right, U.S. banks increase reserves for commercial real estate exposure. They know that they are about to lose. They're going to lose big time, as we have seen over the last while. These companies know what's going on. They call it loan loss provisions, and they've seen the writing on the wall. Okay. Last part of this is the ECB's higher for longer rate plan fails to convince economists. Yes, already believing that March they're going to start cutting interest rates. Where do you think the ECB and the Federal Reserve are going to begin interest rate cuts? I want to talk about this here for anyone on the Discord. What do you think? Let me know over there. I am willing to always converse as much as I can, and I want to know what you think. Many people have started to say it's going to be towards the end of 2023. That's kind of getting pushed out now into the first quarter of 2024. What do you think? I believe that there has to be a crisis before we see an interest rate cut. They don't have to increase again, but where's that crisis? Where's that linchpin? Australians are living longer, but economic security is declining. Same thing, absolutely same thing in Canada and basically everywhere else. Even chocolate, by the way, or cocoa. You could see it. Cacao is one of those commodities where, you would think it's not going to see a slump. It's not going to be like that. But as they mention here, inflation is hitting pockets of consumers around the world. So one thing after another, we've got problems. We could look at the data. We could see it for ourselves. It's right here. All these kind of unusual pieces of evidence start to add up, and we realize actually people are not doing so well. They're spending more on their credit cards than ever before. Now the whole stoppage in payments for the student loans is going away. All the rent moratoriums, mortgages, like all that stuff is gone. All of the stimulus that they were throwing out there has gone or been reduced in most cases. So of course, that's disappeared. You've got an issue with inflation so high. So the expectation here is, okay, inflation's going to go down. But wage inflation, I think, is also a concern because the companies are looking at that and the Federal Reserve is looking at that, and there's only so much that they're willing to take. It's, there should be some wage inflation, let me tell you. But more importantly than wage inflation, we need asset devaluation, asset depreciation. These things got to come down hard to meet the expectations of the average individual. But do you think they're going to allow that to happen? I don't know. Many people believe that there is some serious deflation going to occur, but at this time, it looks like they're trying to create as much inflation as possible. That's what I see. I want you to be able to communicate with like-minded individuals, and you could do that right here at the Discord. Discord's like a chat kind of thing. You could share, you could do whatever you want in there. Essentially, I'm in there every single day. If you want to join me, it's totally free. Link is down in the description near the top there. I will see you over there. Take care.